Basics of corporate taxation. So firstly, we should know the meaning of tax. A tax may be defined as a pecuniary burden laid upon individuals or property owners to support the government. A tax is not a voluntary payment or donation, but an enforced contribution exacted pursuant to legislative authority, and is any contribution imposed by government whether under the name of toll, tribute, impost, duty, custom, excise, subsidy, aid, supply, or any other name. Taxes consist of direct tax or indirect tax. The term direct tax generally means a tax paid directly to the government by the persons on whom it is imposed. Examples include some income taxes, some corporate taxes, and transfer taxes such as estate or inheritance tax and gift tax. While an indirect tax such as sales tax, value-added tax VAT, or goods and service tax GST is a tax collected by an intermediary such as a retail store from the person who bears the ultimate economic burden of the tax. The intermediary later files a tax return and forwards the tax proceeds to government with the return. In this sense, the term indirect tax is contrasted with a direct tax which is collected directly by government from the persons, legal or natural, on which it is imposed. Some commentators have argued that a direct tax is one that cannot be shifted by the taxpayer to someone else, whereas an indirect tax can be. Tax base is the assessed value of a set of assets, investments, or income streams that is subject to taxation, or the assessed value of a single asset that is subject to taxation. Anything that can be taxed has a tax base. The tax base may refer to that of an individual asset, such as the tax base of a house, or a pool of assets, such as the tax base of all houses in a city. For example, the property tax base of a house is its value. The property tax base of a city is the collective value of all taxable real estate in the city. An issue in corporate taxation is the taxation of shareholders who receive dividends or distributions from a company out of profits which have already been taxed. Most income tax systems levy tax on the corporation and upon distribution of earnings or dividends on the shareholder. This results in a dual level of tax. Most systems require that income tax be withheld on distribution of dividends to foreign shareholders, and some also require withholding of tax on distributions to domestic shareholders. The rate of such withholding tax may be reduced for a shareholder under a tax treaty. Some systems tax some or all dividend income at lower rates than other income. For income tax purposes, the sum of all income that is potentially subject to tax is called total income. Net income is total income minus allowable deductions such as pension contributions, union dues, and child care expenses. Taxable income is net income minus certain other allowable deductions such as the northern residence deduction. It can be calculated as gross total income equals to A plus B plus C plus D plus E. Total income equals to gross total income minus deductions under Chapter 6A. Total tax payable equals to tax on total income minus rebates and reliefs under Chapter 8. Here, A equals to salaries, B equals to income from house property, C equals to profits and gains of business or profession, D equals to capital gains, E equals to income from other sources. After studying this lesson, you should be able to basics of corporate taxation, sole proprietorship, residential status of different groups, other related terms. Now let's discuss sole proprietorship. It can be understood under following heads: resident status of an individual, residential status of a Hindu undivided family, partnership firms or association of persons, residential status of company, residential status of every other person. A sole proprietorship, also known as a sole trader or simply proprietorship, is a type of business entity which is owned and run by one individual and where there is no legal distinction between the owner and the business. All profits and all losses accrue to the owner. All assets of the business are owned by the proprietor and all debts of the business are the proprietor's. Advantages of a sole proprietorship are: a sole proprietor has complete control and decision-making power over the business. Sale or transfer can take place at the discretion of the sole proprietor. No corporate tax payments. Minimal legal costs to forming a sole proprietorship. Few formal business requirements. The disadvantages are: the sole proprietor of the business can be held personally liable for the debts and obligations of the business. Additionally, this risk extends to any liabilities incurred as a result of acts committed by employees of the company. All responsibilities and business decisions fall on the shoulders of the sole proprietor. Investors won't usually invest in sole proprietorships. Now let's discuss residential status under the following heads: resident status of an individual, residential status of a Hindu undivided family, partnership firm or association of persons, residential status of company, residential status of every other person. An individual is said to be resident in India in any previous year if he is in India in that year for a period or periods amounting in all to 182 days or more. Having within the 4 years preceding that year been in India for a period or periods amounting in all to 365 days or more, is in India for a period or periods amounting in all to 60 days or more in that year. The essence of Section 6(6) is that where the individual is resident in the previous year but was not resident in India in 9 out of 10 previous years preceding that year, or was not in India for a total period of 730 days or more in 7 years preceding that year, then his residential status will become RNOR. Thus, in order to acquire the status of RNOR, it is sine qua non that on the other hand he should firstly be resident in that year and thus should fulfill either of the conditions of Section 6(6), that is, he should meet either of the conditions of Section 6(1), say, be in India for 182 days or more in the previous year, and thereafter either of the conditions enshrined in Section 6(6) be fulfilled, say, be in India for 182 days or more in the previous year, and thereafter either of the conditions enshrined in Section 6(6) be fulfilled, say, he should not be the resident in India in 9 out of 10 previous years preceding that year. As per Section 6(2), a Hindu undivided family, like an individual, is either resident in India or non-resident in India. A resident Hindu undivided family is either ordinarily resident or non-ordinarily resident. A Hindu undivided family is said to be resident in India if control and management of its affairs is wholly or partly situated in India. A Hindu undivided family is non-resident in India if control and management of its affairs is wholly situated outside India. A resident Hindu undivided family is an ordinarily resident in India if the Karta or manager of the family, including successive Kartas, satisfies the following 2 additional conditions, as laid down by Section 6(6)(b). Additional condition. Karta has been resident in India in at least 2 out of 10 previous years immediately preceding the relevant previous year. Additional condition. Karta has been present in India for a period of 730 days or more during 7 years immediately preceding the previous year. If the Karta or manager of a resident Hindu undivided family does not satisfy the 2 additional conditions, the family is treated as resident but not ordinarily resident in India. Next is residential status of a company. As per Section 6(3), an Indian company is always resident in India. A foreign company is resident in India only if, during the previous year, control and management of its affairs is situated wholly in India. However, a foreign company is treated as non-resident if, during the previous year, control and management of its affairs is either wholly or partly situated out of India. Next is residential status of every other person. As per Section 6(4), every other person is resident in India if control and management of his affairs is wholly or partly situated within India during the relevant previous year. On the other hand, every other person is non-resident in India if control and management of its affairs is wholly situated outside India. Now, before we go further, firstly we should understand income deemed to be received in India. Section 7. Any of the following 3 is an Indian income. If income is received or deemed to be received in India during the previous year and at the same time it accrues or arises or is deemed to accrue or arise in India during the previous year. If income is received or deemed to be received in India during the previous year, but it accrues or arises outside India during the previous year. If income is received outside India during the previous year, but it accrues or arises or is deemed to accrue or arise in India during the previous year. Income accrued in India is chargeable to tax in all cases, irrespective of residential status of an assessee. The words accrue and arise are used in contradiction to the word receive. Income is said to be received when it reaches the assessee. When the right to receive the income becomes vested in the assessee, it is said to accrue or arise. Now let's discuss income from business connection. Income Tax Act does not define the term business connection. A business connection involves a relation between a business carried on by a non-resident which yields profits and gains and some activity in India which contributes directly or indirectly to the earning of those profits and gains. It implies intimate relation between trading activity carried on outside India and trading activity within India, and such relation is contributing to the earning of profit by non-resident. To illustrate the term business connection, following are some instances. Maintaining a branch office, factory, agency receivership or management for the purchase and sale of goods or transacting any other business. Appointing an agent in India for the systematic and regular purchase of raw materials or other commodities or for sale of the non-resident's goods for business purposes or for securing orders in India. Erecting a factory in India where the raw products purchased locally is worked into a form suitable for export abroad. Forming a local subsidiary company to sell the products of the non-resident parent company. Having financial association between a resident and a non-resident company. Granting a continuing license to a resident to exploit for profit an asset belonging to a non-resident even if the transaction might be disguised as out-and-out sale. Now let's discuss some basic definitions under Income Tax Act 1961. First one is agricultural income, and it means any rent or revenue derived from land which is situated in India and is used for agricultural purposes. Any income derived from such land by agriculture, the performance by a cultivator or receiver of rent in kind of any process ordinarily employed by a cultivator or receiver of rent in kind to render the produce raised or received by him fit to be taken to the market. The sale by a cultivator or receiver of rent in kind of the produce raised or received by him, in respect of which no process has been performed other than a process of the nature described in paragraph 2 of this subclause. Any income derived from any building owned and occupied by the receiver of the rent or revenue of any such land, or occupied by the cultivator or the receiver of rent in kind of any land with respect to which, or the produce of which, any process mentioned in paragraphs 2 and 3 of subclause B is carried on. Second is assessee. Assessee means a person by whom any tax or any other sum of money is payable under this Act, and includes every person in respect of whom any proceeding under this Act has been taken for the assessment of his income, or of the income of any other person in respect of which he is assessable, or of the loss sustained by him or by such other person, or the amount of refund due to him or to such other person. Every person who is deemed to be an assessee under any provision of this Act. Every person who is deemed to be an assessee in default under any provision of this Act. Third is assessment year. Assessment year means the period of 12 months commencing on the first day of April every year. Next is annual value. Annual value in relation to any property means its annual value as determined under the section 23. Next is business. Business includes any trade, commerce or manufacture, or any adventure or concern in the nature of trade, commerce or manufacture. Next is company, which means any Indian company, anybody corporate incorporated by or under the laws of a country outside India, or any institution, association or body which is or was assessable or was assessed as a company for any assessment year under the Indian Income Tax Act 1922, 11 of 1922, or which is or was assessable or was assessed under this Act as a company for any assessment year commencing on or before the first day of April 1970. Any institution, association or body, whether incorporated or not, and whether Indian or non-Indian, which is declared by general or special order of the board to be a company. The next one is person. The term person includes an individual, a Hindu undivided family, a company, a firm, an association of persons or body of individuals whether incorporated or not, a local authority, every artificial juridical person not falling within any of the preceding categories. Next is previous year. Previous year, PY, means the financial year immediately preceding the assessment year. In case of a business or profession which is newly started, the previous year commences from the date of commencement of the new business or profession up to the next 31st day of March. The last one is gross total income. Gross income is commonly defined as the amount of a company's or a person's income prior to taking deductions and taxes. For a business, this amount is pre-tax net sales less cost of sales. We have already seen above that how to calculate gross. Now let us check if we have understood the various concepts discussed in this lesson clearly. Assessment year means the period of 12 months commencing on the first day of April every year. Right or wrong? Right. Gross total income is the sum total of 5 heads, namely salaries, income from house property, profits and gains of business or profession, capital gains, and income from other sources. Right or wrong? Right. Direct tax is directly paid by retailer to the government on behalf of us. Right or wrong? Wrong. Now let's revise what we have studied till now. Taxes are the basic source of revenue to the government. Revenue so raised is utilized for meeting the expenses of government as well as to carry out developmental works. Corporate tax refers to a tax levied by various jurisdictions on the profits made by companies or associations. Companies resident in India are taxed on their worldwide income arising from all sources in accordance with the provisions of the Income Tax Act. Non-resident corporations are essentially taxed on the income earned from a business connection in India or from other Indian sources. There are basically two types of taxes, direct and indirect taxes. An issue in corporate taxation is the taxation of shareholders who receive dividends or distributions from a company out of profits which have already been taxed. This contrasts with a partnership or sole proprietorship where the owner of the business is usually taxed only on the profits of the business and not on distribution of profits. Sole proprietorship is a business owned by one person. Under the Income Tax Act, the incidence of tax is highest on a resident, ordinarily resident, and lowest on a non-resident.